Hi everybody. Welcome to the August 2026 Economic and Market Update presented by Commonwealth Financial Network. My name is Chris Fasciano, and I am Commonwealth's Chief Market Strategist. A lack of progress on negotiations to end the war in the Middle East following the signing of a Memorandum of Understanding and a return to military action led to a 21% rise in oil prices and resulted in a mixed month for stocks. Much of the weakness was concentrated in some of the high-flying artificial intelligence beneficiaries focused on semiconductors and memory. However, underlying trends in the market remained positive. Given the sell-off in some of the growth areas of the markets, the Nasdaq was the worst-performing U.S. index. The small-cap Russell 2000 also was down in lockstep with the Nasdaq. However, the S&P 500 and Dow Jones Industrial Average were basically flat for the month. The equal-weighted S&P 500, which removes the impact of the size of the company from the index weighting, once again outperformed the market cap-weighted version by over 1%. Despite the volatility at the index level, underlying strength is a good sign for investors. We are now more than halfway through second quarter earnings season, and corporate America continues to exceed analysts' expectations. Headline growth rates were impacted by some non-operating gains from some of the biggest names. But even if we exclude those, earnings growth has approached 29%. That compares to the 22% that analysts were expecting at the end of June. This would be the second straight quarter of 20% plus earnings growth for the S&P 500. And another encouraging sign, earnings estimates for the third quarter and the full year moved higher over the month of July. Continuing growth in earnings should provide a solid backdrop for investors over the long term. The rise in oil prices, the potential impact they will have on inflation, and a Fed that continues to talk about their focus on addressing that impact through potential higher interest rates pressured long-term Treasury yields. This led to negative return for most major U.S. bond indices. Concerns about the future path of inflation and if and when the Federal Reserve will raise rates to address it played out in the Treasury market. Longer-term Treasury yields moved higher. The yield on the 30-year U.S. Treasury climbed above 5.2%. This was the highest level seen since 2007. Data over the course of the month was mixed, but continued to point to economic growth over the remainder of the year. The June jobs data came in below expectations after several months in a row of higher jobs creation. The good news is that jobs growth was still positive, although at only 57,000 jobs created. Second quarter gross domestic product also came in below expectations at 1.5% annualized growth. This too was a slowdown from first quarter's 2.1% growth level. However, underlying trends were strong in consumer spending and non-residential fixed investments. Strength in these two areas is an encouraging sign that the economy is poised to continue to grow over the second half of the year. At the end of the month, the Fed met and announced that they were holding interest rates steady. While this was in line with market expectations, the possibility that the committee chose to raise rates was not out of the question. But with no change to policy, the market's attention shifted to Chairman Warsh's post-meeting press conference. He continued to emphasize that the central bank remains committed to restoring price stability and repeatedly stressed that the Fed's inflation target remains 2%. Warsh made it clear that recent improvements in inflation are certainly not enough to declare victory. He also noted that the committee would not hesitate to act if inflation remains stubbornly high. The next several updates on the jobs market and consumer and producer inflation will play an important role in whether the Fed remains on hold or considers another rate increase later this year. That likely means continued volatility in both stocks and bonds as markets attempt to gauge the path of inflation. There are certainly other risks that investors should monitor, led by the situation in the Middle East. Until a deal is announced that fully reopens the Strait of Hormuz, higher oil prices will continue to weigh on markets. Also, as attention begins to turn to the fall, midterm elections could cause increased volatility leading up to Election Day. But macro data points remain solid for now. These should lead to continued economic growth, strong earnings growth from corporate America, and further market appreciation over the long term. That's it for this month's update. I'll be back next month to walk through whatever the markets throw our way. Take care, and thanks as always for watching.